As we turn to the U.S., we want to look at what are some of the things that are happening right now that are really impacting rates. And we continue to see the long end, or I should say the steepener. So when I say steepener, it just means that the long end of the curve, the really 7-year all the way to the 30-year, is starting to increase. And the front month, or the T-bills, the overnights, the 7 days, 30 days, those are starting to come down all the way out to the 3rd and 5th year in terms of where that steepener is going, which just means that there's more concern on inflation. But there's some of those different pressure points when we look at just what is happening along that curve. Now, when we look at the evolution of what is happening on the Atlanta Fed, so depending on what metrics you use, the New York Fed has us growing at about, I believe it's 5% for Q1. It revised down a bit just to give you an idea of where things are, but it's at about 5%. But then when you look at the Atlanta Fed GDP, it's showing a growth, basically no growth, and quarter over quarter at 0.1% expected for Q1 of 2022, real GDP. Meanwhile, the consensus is expecting about 2.8%, but that is down from what the expectation was in November of 4.5%. And a lot of that is, again, driven by what is happening with consumption. As we were saying in November and December, we expected the consumer to slow. We expected October to be a big month. It was. If you remember, we were expecting September to be slow, October to be big, and then November, December to be slow. Instead, it was September was a big month, October was a big month, and then November, December slowed. And we see that continuing in January, which again is why some of these estimates are coming down. And this isn't helping. This is just an updated view of my favorite dashboard for those that have been following us. When you look at core CPI, we're at over 5%. When you look at a lot of the different core PCE, we're over 5%. We're at or above 5%, depending on the metrics. Again, all of the important metrics that are used by the Fed to monitor where is inflation, where's pricing, are all well above target. The target being, again, and so the target based on 2% core PCE just gives you an idea, because remember they said about 2%, which just means that they could be within a certain threshold. And you get an idea of where the current moves have gone at the actual 12-month inflation rate, again, over 5% and approaching 6%. And when you look back to the early 1990s, that's where you can see an equivalent time that we were at that level. Now, one of the things that we've been talking about is as to when does stagflation really take hold. I thought we were going to get a slowdown in the rate of inflation January, February, and then wages were really going to start to take hold in that March to May movement. And one of the things that, for someone that's been in the industry as long as I have, for better or worse, typically people quit their jobs December, January, February after bonuses are paid out, and then they go look to take a higher paying job or a better job in their eyes March through May. So March through May is a huge hiring period. March, April, May is when a lot of hiring is done, and it's going to be at higher wages. So again, that's why we expect to see that resurgence of inflation when you look at that March through June period. And then we see it leveling off a bit. And then at that level off point, there's going to be some of that friction back and forth that's going to keep us in a stagflationary level. And then depending on how some of the leading indicators play out, the deflationary push is really either a Q4 or Q1 23 event, which again is not going to be a very bullish backdrop. And this is just looking at the Fed funds futures implied number of rate hikes. Now there's an increasing amount of people that believe that there's going to be 5. I still remain that there's going to be 4, and you get an idea of how much a week changes people's views. And there's starting to get an increase in expectations of a 50 basis point rate hike, not a 25 basis point rate hike. Still think that they stick with 25 and not 50. Now, when we look at just the U.S. Financial terms, you can see that things are getting a little bit tighter, but again, a little bit tighter. It's still massively easy. It's starting to tighten. It's at the highest since early last year, but the financial conditions are still in our favor. They're still in the favor of businesses and consumers, but it's starting to get tighter. And as rates continue to go up, that will also continue to tighten. But these are some of the key pieces when you think about the Fed tightening. What does that mean? And here are some key subcomponent contributors to US PCE Index. And one of the things that I want to point out, because everyone likes to talk about gasoline and energy, which, don't get me wrong, it's obviously a positive contributor to it. But look at food, look at healthcare, look at remaining contribution. So you have things. This is why we try to be very specific about the difference between flexible and sticky. A lot of these drivers that are going to keep us positive in a elevated percent is going to be on the remaining contribution, which a lot of that is sticky. A lot of that is not going away, which is why, again, stagflation becomes the play, not a deflationary cycle. Now, when we look at durable goods, December durable goods came in at negative 0.9% versus the estimate of negative 0.6%. So when you look at, when you take out transportation, it was up slightly at 0.4% versus the estimate of 0.3%. But total year over year, you're still there. When you look at new order industrial, again, it's also coming, this is also looking at it from a fixed dollar point. And remember, because of inflation, because of these different pieces, the dollar value still remains elevated even as volume is dropping. So this is just showing really, I think, how there's still that inflation in there. But there still is buying. It's starting to slow. And it goes back to what we said last year, and we've been really adamant about, that you're going to continue to see that shift from goods into services. And we're seeing that accelerate right in line with what our expectations are when you're looking at the manufacturing, the durable goods versus the services and some of that pricing. And that's when we look at some of the pricing. The preferred inflation gauge for the Federal Reserve is core PCE, which is the blue line at 4.9% annual rate. Cleveland Fed trimmed mean metric at 4.8%, and then the Dallas Fed trimmed mean metric at plus 3%. So you're getting an idea of just where some of these pressures are. And when you look at the key one that the Federal Reserve uses, which is, again, that key gauge, that blue line is coming right back to where we were in the late 80s. But then if you look at the Federal Reserve Bank of Cleveland, the trimmed side, we're at new highs. We're taking out where we were in the 80s. And again, this is just showing no matter the metric you're looking at, the rate of change is accelerating, and it's pulling up a lot of that sticky inflation side that we keep talking about, which is where we see the pressure and why wages really have to increase exponentially to come up with that. But then when you look at the PCE versus the 5-year average, you can get that U.S. personal consumption expenditures typically track it, and we do expect, again, those expenditures to continue to fall. But now we want to get deeper into the personal savings rate, because depending on what metric people use, it looks either really bullish, it looks really bearish. So we're going to show you all of them. So when we look at cumulative excess savings per household by income, you can see that the top bracket of 90% to 100%, you just get an idea of where those percentages are. And this is data only through Q3 of 2021, because remember, there was a big acceleration to the downside on the excess savings in Q4 for Christmas, for the holidays. And as we showed, there was a big increase in same-day cash advances, paycheck loans. And again, those are things that are just showing where that pressure is. So as Q3 continued to dip on the personal savings rate back to pre-pandemic levels, we actually think that could come down even further unless we get a bigger increase in wages to help offset what we've seen for that increase in living wage and in the cost of living. Now, wage growth easing in near term, but you get an idea of year over year. You have that big surge, but it's still rising in the year over year period. But quarter over quarter, we're getting that pressure. And that's the biggest problem that we continue to talk about. Wage growth, always important when analyzing inflation. Employment cost index rose 1% quarter over quarter in the fourth quarter of 2021. Annual change was strong at 4%, which is the highest since the early 2000s. But the key is to look at productivity. If unit labor costs don't soar, there should be some downward pressure on inflation. And that's why the unit labor cost, which we'll talk about in a minute, is going to be very important, because that is a key piece that goes into prices paid. What are the companies being hit with, and then how much of that is going to be able to get passed through into the final producer. So then when you take that and look at productivity, again, productivity was much stronger than expected at plus 6.6% versus the estimate of 3.9% and 5% in the prior quarter. Now, remember what we said then. We said that was because you had a lot of new hiring. And when you have a lot of new hiring, those people are not as effective. And the people that are training them are less effective, because when for those that have started new jobs, you know what I mean. Somebody kind of sits behind you, watching you what you're doing. They're not doing their work. You're going at a snail's pace because you're learning. So you have two people that are not as efficient, as effective. But then, as we said, that also reverses. So here's that big reversal, which is a net positive. And again, those are some things that should continue to be more productive as people take new jobs. But the quit rate is very elevated as we move closer and closer to full employment, because the quit rates are extremely high. That's people that are willingly leaving their jobs. Then you look at job availability, ton of jobs out there. So again, this is where we're getting to that full employment, which is going to put more pressure on the Fed to raise rates. Now, this is just looking at what we've been discussing on the personal savings rate, starting to flatline here, but we do think that there's going to be more pressure just as we go into the, Q1. Personal savings rate hooked back up in December to 7.9%, but we think it's again going to move closer to the 7% through Q1. Fiscal boost for consumers has faded. Government transfer payments now make up 19% of personal income, well off of peak, but still above the long-term average. And as we get the moratorium ending, as we get the student loan for pause coming back, that's going to again pull a lot of these things bit lower. Then when we look at the inflation-adjusted consumption, it's been declining since October of 2021, again, right in line with our expectations. Similar trend happened in October 2020, but obviously there's a very different economic backdrop, and that's why we do expect this to continue to move lower. And this is looking at real dollars tied to 2012 to give you an idea, and again, showing where the inflation-adjusted consumption is falling. As we were saying, we thought October was going to be the peak. So far it was. And then we've had continuous slowdowns, which again continues into January. Now, the efficiency of working from home relative to working on business premise continues to go higher. And the reason why is you're getting into a routine, you're getting into a groove, you're getting into some of this backdrop, which is only going to support people not really wanting to go back to the office. But I just thought this was an interesting backdrop where, because initially people are like, I'm not as efficient, I'm getting distracted. But once you start getting into a routine and your kids go back to school, it makes it easier to set some time aside and to be more productive. And then when we look at employment cost index, so the benefits, when you look at Q4 at 2.8%, total compensation up 4%, wages and salaries up 4.5%. Again, all of these things point to a more aggressive moves up, which is supportive, again, of that inflation narrative when you look at the companies trying to pass through more cost. Now, the question will be, when does the actual local consumer start to reject that? Well, we think that we're starting to get pretty close to those levels, and it's just going to be a matter of when does that really start to increase exponentially. And when you look at wages are the largest concern for companies, and this is why. If you look at Kimberly-Clark, you look at Unilever, you look at a lot of these warnings when you're talking about how much can additional cost get passed through. Now, one of the things that we've been saying that as the supply chain heals a bit, again, it's not going to get all better. It's just going to not be as bad as it was, bringing down some of that cost. The cost savings on the supply chain side are going to be pushed into the labor fund, which again is going to be that driver of that stagflation. But it's also going to impact what are company earnings, what are net revenues, what are margins. And this is going to continue to be a very big piece as labor costs and shortages remain the biggest problem, which is also starting to impact the outlook on people's finances. So we'll be better off than now is falling. We'll be worse off is starting to increase because, again, they're not seeing their wages keep pace with their cost of living, which is causing them some friction and underlying impacts. And again, if you're concerned about that, you're not going to spend as much. So contributions to increased wealth during the pandemic vary obviously by the percentiles. So you can see that the 99th to 100th, so the top 1%, equities, mutual funds, when you look at 80, so that top 20% is a huge percentage of just that growth growth in net worth, which is why when people say, well, like people got rich during this period, or there's so much savings on the sideline, it's like, well, yeah, and in that upper piece. Now, the bullish side of it is, well, those are the individuals that spend the most anyway, which is true. But when you look at where their jobs are, where their views are going, how they're looking at the world going forward, how much of that is going to continue and how much of it just stays in savings or starts to actually come out as people try to lock in some gains. So then when you look at the credit card side, it's still gotten better. So the delinquency rates have fallen to a near all-time low. At least on this chart going back to 1991, it is the lowest it's ever been. But that's because people had cash, they paid down their credit cards, they were able to get out of delinquency. But now, as we've been saying, we're starting to see that climb back up, but not on the delinquency side. You have to borrow from the credit cards first, which has been increasing over the last several months, and then you have to not pay it. So again, there's a certain timing delay. So we want to see where this sits really in March to get an idea of that increase in credit card spending that happened in November through February. Where does that sit as we get into the Q2? So U.S. wages will be accelerating. I think that's a given. The question is going to be the rate of change and does it catch up and overtake where inflation is? And I think that's going to be the biggest unknown, especially when you look at how it's going to impact underlying spending. Now, as we look at the adjusted retail sales, sharp turn lower in retail sales relative to inventories. Given the surge in inventories, the ratio is now less than 1 for the first time since early 2021, because we did have, we said, some fix in the supply chain, which has then increased some of the underlying inventory, which was a big positive contributor to GDP, which we'll talk about in the next segment. But real total consumption, again, falling below the trend line, and it's something that we think is going to continue to trend down. But it is going to be shifting. So the goods continues to fall, services continues to go up. We think that the goods is going to accelerate a bit faster than the services is going to increase. But again, we do see more growth on the service sector. Now, one of the reasons why the goods is going to slow is because there's a backlog. So people have already spent it. U.S. household appliance manufacturing unfilled orders going back to 1992, it's approaching $3 billion. So again, it's just people are waiting for delivery. So why are you going out and buying anything new? So then when we look at U.S. Employment Cost Index and Consumer Price Index, you get an idea of where those costs are going, how inflation is well above those where employment costs are, and again, going to continue to pull that to a higher level. Then when we look at CPI urban consumers, nominal output gap, which is the orange line there, looks to be closing. Historically, that was often associated with higher inflation, which again continues to be the driving point going forward. So now in the next segment, we're going to look at how was all of this impacting GDP, how did it impact it in Q4, and what is it going to do in Q1 and throughout the rest of 2022.